Your mortgage payment went up $200 and nobody called to explain why. It's almost certainly escrow, and there are really only two things that can cause it. Once a year, your servicer runs the math on what your taxes and insurance actually cost, compares it to what it collected, and if either bill rose, you get hit twice. Once to cover the hole that's already there, and again in the new monthly number going forward. Here's the good news. The process is federally regulated top to bottom, so nothing about that letter is a mystery once you know where to look. So let's walk the whole thing. What escrow actually is and why the account can come up short. The annual analysis your servicer is legally required to run and the cap on how much cushion it can hold. Your repayment options when there's a real shortfall. The refund rule that works in your favor when they've collected too much. A flowchart for reading your own statement in 5 minutes, and what you can actually do, whether that's catching an error, appealing your tax bill, or shopping your insurance, before you just accept the new number. Think of escrow as a forced savings account your servicer runs for you, not a fee on top of your mortgage. Every payment you make gets split 3 ways: principal, interest, and a slice that gets parked specifically to cover your property tax bill and your insurance premium when they come due, so you're never staring down one enormous bill in November. And that cushion, the rule allows, capped at roughly 2 months' worth of what actually goes out the door each year, exists because tax and insurance bills don't land on a neat monthly schedule. Some counties bill twice a year. Some servicers pay insurance a full year in advance. The cushion is not the servicer building a slush fund at your expense. It's explicitly capped so they can't overcollect just in case. Which is exactly why, when either bill jumps, that cushion gets eaten fast and the math stops working. Here's the mechanism, because hit twice sounds like a scare line until you see the math. Say your county reassessed your home and your tax bill jumped by $1,200 this year. Your servicer already paid that higher bill out of an account that was funded for the old, lower number. So there's a hole in the account today, a real shortage. That's increase number 1. But your servicer doesn't just patch the hole. It also recalculates what it needs to collect from you every month going forward based on the new, higher tax bill. So your baseline payment goes up too, permanently, independent of the shortage repayment. 2 separate increases, 1 root cause, and if you only budget for the second one, the first one blindsides you. This isn't optional or something a servicer does when they feel like it. It's a yearly, rule-mandated reconciliation, and the paperwork it produces is the letter that just landed in your mailbox. Somewhere on that statement is a full history. Every dollar that went in from your payments, every dollar that went out to the county and your insurer, month by month. Most homeowners skim past that history table straight to the new payment number at the bottom, which is exactly backwards, because the history table is where you'd actually catch a servicer error, like a tax payment posted twice or a premium paid to a policy you already canceled. Read the history before you accept the projection. 2 months might sound like a decent buffer, and normally it is, until a tax bill jumps by a few $1,000s in one reassessment cycle, which happens more than people expect given how fast home values have moved in a lot of counties lately. When that happens, the entire 2-month cushion the rule allows can get consumed in a single disbursement, and the account doesn't just dip, it goes negative. That negative number is your shortage. Knowing the cap exists tells you something useful. If your servicer's statement shows a required cushion, way north of 2 months of your actual bills, that's worth questioning. It isn't supposed to be a rainy day fund beyond what the rule allows. Treat this like a checklist you can run in 5 minutes with the statement in front of you. Step 1. Skip the summary box and go straight to the transaction history. That's where a real mistake would show up, not in the projected payment. Step 2. Do the arithmetic yourself. Add up what was collected, subtract what was actually disbursed, and see if the ending balance matches what they claim. Servicers make errors, and you're allowed to check their work. Step 3 is the one that actually matters for what you do next. Don't just accept your payment went up. Find out whether it was the tax line or the insurance line, because that determines your entire next move. Step 4, go fix the specific number, which we'll walk through next. And step 5 is your safety valve. If something genuinely doesn't add up after you've checked it, there's a formal timed process for making them explain it, and it works. Here's where a lot of homeowners assume they have no leverage, and that's not quite right. If the shortage is small, less than 1 month's escrow payment, the rule actually leaves the choice with the servicer, not you. It may do nothing. Ask for it within 30 days or spread it across a year or more. You can always offer to pay it off in one go, but you cannot demand a particular option at this tier. Once the shortage hits a full month's payment or more, the servicer's own menu narrows to spreading it over at least 12 months or just letting it ride. They're not required to offer you a lump sum button on that statement. But here's the part worth knowing. Nothing stops you from sending in extra money on your own to knock the balance down faster, even on a spread plan, if avoiding a permanently inflated monthly payment is worth it to you. Read which bucket your shortage actually falls into before you assume you're stuck. The same analysis that can hand you a shortage can also hand you money back. And this direction of the rule is one people miss because nobody mailing you a check unprompted feels suspicious until you actually check the statement. If your account came out ahead by $50 or more, say your tax bill actually came in lower than projected, the servicer doesn't get to just quietly roll that into next year's cushion. The rule requires an actual refund within 30 days. Below $50, they get some discretion. Crediting it forward is allowed. The one catch: this protection assumes you've been paying on time. If you're more than 30 days behind, a servicer can apply a surplus toward what you owe instead of cutting you a check. Worth a specific look on your statement, not just an assumption everything nets to zero. This is the slide to actually act on, so let's get specific about each lever. If the number that moved was your property tax bill, an assessment appeal is a real, often successful process. We walked through exactly how to file one in our property tax appeal episode, and a successful appeal doesn't just lower this year's bill, it lowers every future escrow projection built on it. If it was your insurance premium, treat the renewal like the transaction it is. Get 2 or 3 competing quotes before you auto-renew, because premiums in a lot of markets have moved enough lately that loyalty is expensive. And if the number is simply correct and you just don't like it, paying the shortage in one lump sum, instead of the 12-month spread, means your monthly payment stops carrying that extra shortage installment on top of the new higher baseline, which is often the single biggest lever you actually control. Run your own statement down this table before you decide whether you're disputing a mistake or just absorbing a real cost. The left column is where a notice of error actually has teeth. The history table doesn't reconcile. They paid a tax bill on a parcel number that isn't even yours. They kept paying a homeowner's policy you already switched away from, or the cushion they're holding is bigger than the cap allows. Any of those is a documented, citable error worth a formal complaint. The right column is the harder pill. Your county really did reassess your home. Your insurer really did raise the renewal. The math genuinely reconciles, and the statement arrived exactly on schedule. That's not a violation to fight. It's a real cost to manage through a tax appeal, an insurance shop, or a lump sum payment, not a dispute letter that's going to get denied. There's a specific, named tool for this, and it's more powerful than a phone call because it starts a legal clock. A notice of error is a written letter through the servicer's designated address, which is usually printed right on your statement, that identifies you, your loan number, and exactly what you believe they got wrong. Vague complaints don't qualify, so be specific about the dollar figure or the parcel number that's off. Once it lands, they have 5 business days just to acknowledge they got it, and then 30 business days to actually investigate and respond in writing. With one 15-day extension, they're allowed to take if they tell you in writing first. If they blow past that window entirely, or their answer doesn't actually address what you flagged, that's your cue to take it to the CFPB, whose complaint process is free and puts a response deadline on the servicer from an outside party instead of just you. Most of the money lost here isn't lost to some elaborate servicer scheme. It's lost to homeowners never actually opening the statement past the summary page. Mistake 1. Seeing a bigger number, assuming it's correct, and just paying it without ever checking whether the underlying tax or insurance figure the servicer used was even right. Mistake 2, and this one causes real confusion, treating the shortage repayment and the new ongoing payment as if disputing one fixes the other. They're two separate line items with two separate causes, and you may need to address both. And mistake 3 is the costliest one, spending weeks going back and forth with your servicer about a tax increase you actually disagree with, while your county's assessment appeal deadline, which is often a hard, unmovable date measured in weeks, not months, quietly closes. If the tax number is what you're disputing, the appeal clock matters more than the escrow clock. So here's what to actually walk away with. First, escrow is simple math running in the background, a monthly slice for taxes and insurance. And when either bill moves, the account math moves with it, which is normal, not a scam. Second, remember why the bill feels so big. You're very likely seeing two increases stacked into one number, the shortage catch-up and the new ongoing payment, and separating them is the first thing that makes the letter make sense. Third, none of this is a black box. The annual statement, the cap on how much cushion they can hold, and your options for repaying a real shortage are all spelled out in federal rule, which means you can check the math instead of just trusting the total. And last, the fix lives upstream of the escrow account itself. Appeal the tax assessment if that's what moved. Shop your insurance if that's what moved. And if it's simply real, consider paying it off in one shot instead of carrying it for a year. This video is general education, not legal, financial, or tax advice. And the rights and processes covered here, escrow analysis timing, the cushion cap, shortage repayment options, surplus refunds, and the notice of error process, can vary by your servicer, your loan documents, and your state. It was researched and produced with AI assistance, including script research, voice, and on-screen graphics, and reviewed by a human against the cited sources before publishing. Before you act, read your own escrow statement in full, check your loan documents and your state's property tax appeal deadlines, and if a shortage looks wrong, a refund never arrives, or your payment is becoming unaffordable, talk to a licensed attorney or a HUD-approved housing counselor in your state. Subscribe. Homeowner Rights Explained breaks down one homeowner right every video.